Welcome to Dr. Dan's channel. I'm glad you could join us today. We are going to talk about something serious. A major shock just hit the US stock market. In a single day, nearly $1 trillion in value disappeared. This is not just a headline for Wall Street. It has real-world consequences for your job, your retirement savings, your family's budget, and the plans of businesses big and small across the country. We need to understand what happened. And more importantly, we need to understand why it happened. This is a story about money, technology, and fear. Let's set the scene. Imagine the digital tickers on trading floors, not glowing green, but flashing a deep, angry red. The S&P 500, a broad measure of the market's health, slid by about 1.7%. The Nasdaq Composite, home to many of the world's biggest technology companies, dropped around 2.3%. The Dow Jones Industrial Average, an index of 30 major U.S. companies, fell about 1.7%. These numbers represent a massive, swift erosion of wealth. It was a day of reckoning that left investors and analysts scrambling for answers, asking a single urgent question: what went wrong? The pain was not spread evenly. The market's biggest and brightest stars were the ones that fell the fastest. Shares of Tesla, the electric vehicle giant, plunged by roughly 6.7%. A fall like that hit sentiment far beyond one ticker. NVIDIA, the chip maker at the heart of the AI revolution, saw its stock fall about 3.6%. Palantir, a data analytics firm, sank by around 6.5%. These are not small companies. These are titans of the modern economy. When they stumble, they create tremors that are felt far and wide. The headlines that followed were stark, painting a picture of a market gripped by pessimism. Reuters pointed out that the steep decline was led by technology stocks, the very same stocks that had propelled the market to new heights. They also noted a critical shift. December rate cut odds slid from about 67% to roughly 53%. Over 2 brutal days, more than $1.5 trillion in market value were erased, as reported by the Economic Times. The Telegraph noted over $1 trillion wiped from large U.S. tech firms in just a week. That's bigger than the economies of many countries. Suddenly, 3 pillars looked shaky: high-flying tech, an accommodating Fed, and stable politics. This wasn't a simple correction. It felt like a vote of no confidence in the near-term outlook. The speed of the decline tells you investors were caught off guard. Result? A rush for the exits. Sell first, ask questions later. That is how you get $1 trillion loss in a day. It was not just one thing, it was a combination of forces, 3 main drivers. Let's unpack: rate cut confusion, a tech AI bubble risk, and political policy volatility. Now let's examine the first major cause: confusion over the Federal Reserve's next move. The Fed, America's central bank, has a powerful tool: the federal funds rate, the interest rate at which banks lend to each other overnight. It influences borrowing costs for everyone, from families buying a home to companies taking out loans to expand. Earlier in 2025, the Fed cut twice, September and October. Markets loved it and expected more. At one point, odds of a December cut were seen near 96%. Then officials turned cautious, jawboning that a December cut wasn't assured. Those odds quickly slid to around 52%. For a market leaning hard on cheaper money, that was a rude awakening. Higher for longer rates threatened debt-fueled growth and lofty valuations, and the timing got worse: a U.S. government shutdown. Agencies that publish critical data closed their doors. Key reports on jobs, inflation, and international trade were suddenly delayed. The information flow markets and the Fed rely on was cut off. A dangerous information vacuum formed, and markets hate uncertainty. Without data, traders guess, rumor takes over, jobs and CPI guide the economy's pulse. Without fresh readings, the Fed flew partially blind. Cautious Fed comments grew more potent in the dark. When reports dam up, pressure builds, next data point hits like a hammer. Volatility surged. Every rumor, every Fed syllable got magnified into $1 trillion loss. Trigger 2. The AI Froth, and Valuation Vertigo. For 2 years, AI was Wall Street's hottest story. Generative AI launches sparked an investment frenzy. Companies poured billions into AI capabilities. Investors chased anything with an AI tag, sending valuations into the stratosphere. But the question grew louder. Where are the profits? One study cited on Wikipedia found roughly 95% of organizations saw no tangible return yet from generative AI. A disconnect between hype and reality. Ray Dalio warned of dot-com-style bubble risks. The Financial Times and Bloomberg flagged Froth. Valuation vertigo set in. Prices presumed a perfect future. AI revolutionizing everything, profits seamless. Then doubts on the Fed, the economy and AI returns shook that future. Riders of the wave started cashing in their chips. Concentration made it worse. Investopedia highlights, 7 tech AI giants now make up roughly 32% of U.S. market value. This magnificent 7 steered the indices higher. But when leadership narrows, fragility rises. A stumble from 1 or 2 can ripple through everything. A miss, new rules, or a mood swing can trigger outsized falls. Their size amplified the wipeout across the board. A market this concentrated is a fragile structure. When leaders falter, there may be nothing broad enough to hold it up. The third piece is political and policy volatility. Businesses need predictability. Taxes, trade, regulation. Chaos creates a cloud of uncertainty, a tax on the economy. New tariffs and trade fights raise costs and invite retaliation. Back and forth rhetoric destroys planning for supply chains. Shutdowns disrupt data and directly hit the economy. Workers go unpaid, contracts pause, services close, confidence erodes. Brinkmanship signals dysfunction, bad for business and investors. Mix the Fed's uncertainty, tech froth, and political noise, risk premiums rise. That price of risk showed up in the trillion-dollar sell-off. This isn't just New York money, it hits Main Street. Markets fall, businesses get cautious, investment and hiring slow. Households tighten spending, growth cools further. Tech size matters. Most retirement accounts sit in index funds heavy with big tech. When tech falls, millions of 401ks fall too. Fed delays keep borrowing expensive, mortgages, car loans, credit cards. For small firms, higher costs can mean shutting down instead of expanding. From Wall Street screens to boardrooms, to housing and autos, to kitchen tables. A trillion-dollar wipeout is about the health of the whole economy and every citizen's financial well-being. So what is this? Bubble or correction, and what happens next? We lay out the scenarios: stabilization, deeper correction, or a policy pivot. So, what is this? A full-blown bubble starting to pop? Or a short-term correction washing out excess? No one knows for sure. Experts are divided. Classic signs: high valuations, speculative AI frenzy, narrow leadership. Counterpoint: unlike .com, many big tech firms are highly profitable with solid balance sheets. Maybe this is rotation, money leaving the priciest stocks for more reasonable areas. Scenario 1, stabilization. Government reopens, data drops, jobs and inflation look decent. Fed signals cuts, tech earnings remain strong, confidence returns. The loss is a temporary blip, the market bounces back. Scenario 2, deeper correction. Economy slows, inflation stays stubborn, Fed holds higher for longer. Tech misses, selling continues, recession risk rises. Scenario 3, policy pivot. Leaders act, stimulus or a big trade agreement, confidence restored. But fixes are slow and politically hard. Markets may suffer until a credible plan appears. What should you take away? This trillion-dollar loss is a signal about high valuations, an uncertain Fed, and political risk. Watch the data: jobs, inflation, and trade. Listen closely to every word from the Fed. Their signals steer rates. Track big tech earnings. Can profits justify prices? For your finances, don't make rash moves on one bad week. Review goals and diversify. No all eggs one basket. Workers, watch hiring in your field. Consumers, keep a cushion. An emergency fund helps in uncertainty. Market swings are normal. Prudence is a virtue. The question isn't just how much was lost, it's whether the US economy and its policy engines can regain the confidence they just lost. $1 trillion is a mind-boggling amount of money. But the real story is what happens next. The coming weeks will be a crucial test. Will Washington restore clarity? Will data show the foundation is strong? Can AI profits become real and sustainable? Those answers decide if this was a brief shock or the start of something more serious. Thank you for watching. If you found this useful, please subscribe to Dr. Dan's channel. Leave a comment below. What do you think happens next? Share this video with friends and family who want the news without the noise. Subscribe, comment, share.